Hi, I'm Ross Mayfield, investment strategy analyst at Baird, and we are back for another weekly video with our friends at Strategas. This week, I'm thrilled to be joined by investment strategist Ryan Grabinski. Ryan, how are you doing today?
I'm doing well. Rolling into the end of summer, things are quiet, and we're looking forward to the Labor Day holiday here.
Absolutely. Well, before we get there, you all released another edition of your market balance sheet, which we based the Baird Market Gauge off of. And I wanted to talk through it with you. Some good news this edition, you shifted sentiment from a liability to an asset, which shifted the overall gauge positive, which is great news. It's kind of a broad indicator of how we can look at the markets right now. So talk to me about why you all decided to shift sentiment from a negative to a positive.
Yeah, sure. So there are really two reasons for this change in this iteration of the market gauge. The first really has to do with the significant decline in the cyclical flows into equities. This ultimately suggests that sentiment is no longer euphoric for the reflation trade, and one could tell by looking at the levels of the S&P and even the Dow, the market has been able to remain elevated despite these flows being a little lackluster. So that's really the first reason. The second is related to our sentiment dashboard, which ranks various sentiment surveys, and ultimately in the months prior, it was showing that some of these readings were a little bit extreme, but those readings have since come in. So that was really the other reason for making the change.
Yeah, sentiment, it's a funny thing to talk about because it's kind of contrarian to what you might think. So when sentiment is deteriorating a little bit or getting a little more reined in, actually a positive for markets in the long term. So that's great to hear. Good news overall. Let's shift a little bit. Are there any indicators that are concerning you or any indicators on the horizon that you might see shifting from positive to negative on the flip side?
Sure. So, obviously the one indicator that we have the biggest concerns over is valuation. Valuation continues to remain elevated. The S&P is trading at about 22 times forward earnings, which is always a concern. But when you look at things in relative terms rather than absolute terms, it's hard to call equities expensive, especially compared to the alternatives of fixed income investments. So that's really how we get comfortable with valuations, even though they're a bit stretched here. As far as the metrics that could potentially shift in the coming months, I think the one that we really have our eyes on is profit growth / margin. Ultimately, the first 2 quarters of the year, we've seen tremendous surge in earnings growth. And we would expect that to continue throughout the second half of the year, but we do believe that the growth rates are going to come down a little bit. One of the things that we're starting to hear more and more on company conference calls is that the Delta variant is beginning to impact revenues, and that's especially in the travel related industry. Some of the airlines have ultimately suggested that they're seeing bookings decline, so that is a little bit of a concern. Margins, when we think about margins here, margins have expanded pretty significantly off the lows. They're even above the pre-COVID levels and even above the peaks that we saw during 2018. At the end of the day, inflation is starting to, obviously is top of mind. And, our biggest concern with margins is that costs are going to be rising for companies and that it's ultimately going to slow the margin expansion, if not stall it out altogether. And historically, equities do not get into too much trouble until margins actually begin to roll over. So the extent to which margins do stall out here, if they do, that'll be the one metric that we're watching. And of course, profit growth will slow if that's the case.
Yeah, the margin story has been nothing short of extraordinary. I mean, the input cost pressures that we're seeing from labor costs to raw materials, and yet these companies just continue to churn out better and better results. So it's been really impressive. And I want to use that to kind of pivot into a last question here that's a little bit off the market gauge, because you're talking about inflation, and we're going to get some Fed speakers over the next couple of days. It'll happen by the time this video is out at the Jackson Hole Symposium. They're going to talk about tightening policy. Inflation is a concern for theirs. How are you thinking about this conference, tapering asset purchases in general, and the overall tightening of monetary policy?
Yeah, I think, overall, I think we have to just kind of keep things in perspective and really remember that the Fed is going to remain easy for the foreseeable future. The recovery is obviously still fragile, and we're still in the early innings of it. And ultimately they have to communicate this. The communication is going to be the most challenging portion of this for them. If we look back to 2013 when the Fed tapered, equities actually continued to do quite well. That was leading up to the ultimate taper tantrum, and then during the taper tantrum, they continued to do well. So, a lot of the yield-oriented sectors did sell off back in 2013 during the taper tantrum, but the cyclically oriented sectors, which have done well, and we believe will continue to do well, should ultimately be able to lift the market higher. As far as ultimately tightening goes, or raising rates. The market still continues to believe that this is a 4Q 2022 story. So, that's quite a ways out. It's still a long way out. And when we look at even in historical rising rate cycles, it's not necessarily the first Fed rate hike that matters. It's ultimately the last. Equities after the first rate hike, equities have continued to do well. So, we're keeping an eye on it overall, but you kind of have to stay the course in terms of your equity allocations and being long the market here. There's the alternatives might present a bigger risk ultimately.
Yeah, stay the course is the name of the game, and the Fed they've got a long rollout ahead of them. So we'll keep an eye on it. We'll keep reading your stuff, and we'll look forward to the next version of the Market Gauge to see if anything changes. So thanks for stopping by.
Thanks, Ross. Always my pleasure.